Good morning, Trinidad and Tobago, and welcome to the Bourse Report. Well, earnings season for the third quarter has begun, and today we're taking a look at the manufacturing sector for two more of the more popular companies or groups in that particular sector. We're talking about West Indian Tobacco Company Limited, or WCO, and Angostura Holdings Limited. Now, both companies would have had fairly divergent fortunes for those 9 months completed in the year thus far. However, things may be beginning to become or appear a bit brighter with traditional entertainment and distribution channels on the brink of reopening. So how did those companies perform and what can we expect? Let's take a look. Turning firstly to the West Indian Tobacco Company, or WCO, the group would have delivered earnings per share of $1.07, which was a 10% decline from the $1.19 recorded in that prior comparable period. And that really was driven by a decline in revenues, down 7.4% from $659 to $610 million. Operating profits declined 11.2% from $431 million to just around $380 million. And profit for the period overall declined from $301 million in the 9 months of 2020 to $270 million in that most recently concluded fiscal period, the 9 months of 2021. That's ended September 2021, of course. When you take at revenue and revenue growth trends, well, it has been not very good reading for WCO shareholders after a 6.2% decline in revenue over that 9 months 2020 period. That decline has actually accelerated a bit from the 7.4% down, with total revenues coming in at around that $611 million mark for the 9-month period of 2021. Again, bear in mind that traditional distribution channels, namely bars and other entertainment avenues, would have been closed for a prolonged period of time, and that certainly would have weighed on WCO's revenue generation. Illicit products also, and perhaps with the advent of COVID and the impact on your respiratory system, maybe some transitory, perhaps, changes in consumption patterns, maybe a reduction in consumption patterns, which cannot be proved empirically as yet, but only time will tell. But nonetheless, there has been that ongoing decline in trend of revenue generation for WCO. When we take a look at how that would have impacted dividends for shareholders, well, it has been material. Dividends per share over the past couple of years from 9 months 2017 to 2019 would have been around that $1 level, including the 9 months of 2020, 93 cents declared or paid in the first 9 months of 2020. That has decreased to just 72 cents in the most recent 9-month period of 2021. So certainly investors and shareholders might be feeling the pinch when it comes to cash flow received from their WCO shareholding. Nevertheless, despite revenue challenges, WCO does trade at a price of $29.87, which is a price earnings ratio of just under 20 times, which is well below the sector average of 28.3 times, which is a good thing. However, pretty much in line with historical norms, but it does offer quite an attractive dividend yield at current prices and trailing dividends of 6.3% compared to that 3.6% for the sector average. So notwithstanding those revenue challenges, the attractive dividend yield does make it somewhat make persons consider acquiring the stock. But because of that economic uncertainty, of course, Bourse is going to maintain a neutral rating on WCO going forward. Turning quickly to the Angostura Holdings, the group would have recorded earnings per share figure of 45 cents per share compared to 39 cents in the prior comparable period, a 15.4% increase, so quite impressive there. In contrast to WCO, revenues for Angostura Holdings were actually up from $574 million to $613 million, despite traditional distribution channels in the domestic economy remaining closed. Gross profits up 8.2% from $269 to $291 million, and overall profit for the period increasing just from $80.7 million to $92.3 million, so a 14.4% increase in profits for the period. So some good momentum or good continued momentum for Angostura Holdings Limited, despite the ongoing domestic economic challenges. When we take a look at Angostura or AHL's profit margins, we can see that there has been some marginal recovery at the gross profit margin level in that teal color. We can see that gross profit margins improved from 47 to 47.5%, and profit after tax margins actually improved from 14.1 to 15.1%, despite a marginal decline in operating profit margins from 18.6 to 18.2%. Now, at a price of $17.10, AHL is trading at a price-to-earnings ratio of 22.2 times, again below the manufacturing sector average of 28.3 times. Still a little bit expensive compared to historical averages for Angostura on its own, and offers investors a dividend yield on a trailing basis of 2.3%, which is admittedly below that 3.6% for the sector. On the basis of those recovering/improving margins, relatively fair valuations, again, in contrast to its historical norms, and with that economic reopening, which both WCO and Angostura will be hoping to stimulate some more business activity and revenue generation, Bourse is going to maintain a neutral rating on AHL for now. Well, that's it for this week's edition. For more information, you can give us a call at 226-8773, email us at invest@boursefinancial.com, or check out our website, where all of our research is absolutely free, at bourseinvestment.com. And of course, you can catch us in today's Bigger, Better Trinidad and Tobago Guardian in that business section. So until next time, stay safe, get vaccinated, and see you next week on the Bourse Report.